August 14th, 1971. Two portfolio managers sit in separate Wall Street offices. Both manage $2.1 million. Both trust the post-war economic order. Their strategies could not be more different. Arthur holds long-duration bonds, treasury bills, and cash. His strategy is built on stability. He trusts the dollar's purchasing power. His average yield sits at 4.2%. Thomas holds 40% in physical gold bullion, 20% in mining equities, and 40% in short-term bills. Colleagues call outdated. They say he is leaving capital on the table. 24 hours later, President Nixon addresses the nation. Dollar convertibility to gold is suspended. The Bretton Woods system is dismantled. Markets do not crash immediately. They freeze. Then they adjust. By 1974, inflation rises 34%. Arthur's bond portfolio begins bleeding real value. His statement still shows $2.1 million, but his purchasing power has contracted by nearly a third. By 1980, the divergence is complete. Inflation peaks at 13.5%. Gold reaches $850 per ounce. Thomas's allocation multiplies. His equities outperform the market by a factor of 9. Same starting capital, same economic environment, completely different outcomes. Arthur held promises when the issuer changed the rules. Thomas held collateral when the market stopped trusting the issuer. This was never about market timing. It was about monetary architecture. The dollar did not lose value because the economy weakened. It lost value because the anchor was removed. I call it the sovereign anchor shift, a framework describing how reserve currencies lose purchasing power, not through panic, but through a forced recalibration of collateral hierarchy. It operates independently of politics, driven by three variables: debt ratios, foreign reserve behavior, and real yields. When these cross thresholds, the system can no longer maintain its exchange paradigm. Central banks face a corner. Contract money supply and trigger defaults, or expand it, triggering currency dilution. History shows the choice is rarely a choice. The path of expansion is select. Phase 1, credit illusion and quiet dilution. Rates are held low to stimulate borrowing. Money supply expands. Asset prices rise. The public perceives stability. Capital chases yield, mistaking liquidity for safety. Phase 2, confidence erosion. The math catches up. Debt costs outpace revenue. Inflation embeds in supply chains. Central banks try to normalize rates. Bond markets reject higher yields. The curve inverts. Phase 3, policy exhaustion. Raising rates triggers fiscal crisis. Holding steady loses reserve status. The system chooses the path of least resistance. Rates stay low. The currency depreciates sharply against hard assets. Phase 4, structural repricing. The market finds equilibrium. Currency settles at a lower tier. Gold establishes a new baseline. Wealth is permanently redistributed from paper claims to recognized collateral. The data shows this sequence repeats. 1933. The dollar is pegged at $20.67. Money supply contracts 30%. Deflation crushes borrowers. Banks fail. Roosevelt revalues gold to $35. A 69% devaluation against its own anchor. The monetary base expands. Deflation ends. Wealth transfers from creditors to those holding physical metal. 1971. The post-war order strains under deficits. Foreign banks demand gold settlement. U.S. gold stocks fall from 20,000 to 8,000 tons. The system cannot honor. Nixon suspends convertibility. The dollar floats. Gold rises to $850 by 1980. Inflation peaks. Those relying on deposits lose half their real wealth. The data is unambiguous. 2008. The financial system collapses. The Fed cuts rates to zero. The monetary base expands from $800 billion to $2.7 trillion. Gold rises 140%. 2020. Pandemic shutdowns trigger unprecedented liquidity. Money supply expands 25% in 1 year. Gold breaks $2,000. Real yields turn negative and stay there. This is not opinion. This is arithmetic. When liabilities outpace capacity, the system must adjust. The adjustment is mechanical. It is historical. It is always priced in before headlines acknowledge it. Right now, the architecture mirrors pre-1971. Central banks buy over 1,000 tons of gold annually. Foreign holders reduce treasury exposure. Debt to GDP sits above 123%. We're no longer in phase 1. The credit illusion has fractured. We are transitioning into phase 3. Confidence in dollar permanence is eroding. Capital is rotating from paper to proof. Track the signals. First, for treasury holdings. A sustained decline signals reserve diversification. Second, the gold forward rate. When it turns negative, physical demand exceeds paper supply. Collateral flight begins. Third, cross-currency basis swaps. Widening negative readings show global dollar funding stress. Fourth, central bank gold purchases. Consistent buying above 800 tons confirms a structural anchor shift. Return to Arthur and Thomas. The year is 1985. Inflation is tamed, not reversed. Arthur's bonds mature. He reinvests at higher rates, but his original capital's real value never recovers. Thomas liquidates gold at the peaks. He redeploys into real estate and dividends. By 1985, his fund outperforms the market by 210%. His clients fund the recovery. Same starting point, different understanding. Arthur managed numbers on a screen. Thomas managed collateral against a weakening denominator. One trusted the issuer. The other respected the history. History rhymes through mathematical necessity. When backing shifts from collateral to credibility, the system recalibrates. Gold rises because the measuring stick falls. Wealth transfers to those who read the mechanism. You do not need to predict the future. Only recognize where we are in the sequence. The anchor shifts. The collateral reprices. The mechanism operates independently of opinion. It only requires observation.